speculative appetite. You were talking about the favorite meme stock a few moments ago. The public is still engaged. Volumes are still heavy. Flows are still strong. But on the other hand, you have come this long way. And clearly what we're seeing is that the value trade, which has really led the way, and we think long-term continues to lead the way, is coming under pressure because we're in one of these patches where the news on the virus is unfortunately a little bit on the soft side, particularly in Europe. So what we're telling people is if you're happy with the way your portfolio looks and you can imagine yourself to be a buyer down 10 to 15%, that's the mindset you want. You don't want to have to hedge the downside now. If you're thinking about needing to do that, hedge it at the moment when options are cheap, when the VIX is trading under 20. But, long term, we do believe there's more to go.
Julian, always great to catch up with you, buddy. Great to hear from you. Julian Emmanuel there, BTIG Chief Equity and Derivative Strategist, the man that's really respected the retail flows. And Lisa, I think one thing that's frustrated me personally is the sneering around the retail story over the last 12 months. And something that stuck with me over the last 24 hours is something that Sam Rowe of Yahoo said out on Twitter. Let me read this to you, but I think it's actually really interesting and spot on. There's been outrage over how poor people aren't making money in the stock market like rich people, and then also outrage over how poor people are putting their stimulus checks in the stock market. Where's the issue here, Lisa?
Honestly,
that people are engaging in the market.
That's not the issue. The issue is concern about not understanding it fully, and I think that really is the ultimate question. How do you get your handle around these retail flows?
That's often associated with some snobbery, though. Part of the learning is engaging. That's where you make your lessons, particularly early on. We'll talk about it more later. From New York City this morning, good morning. Alongside Lisa Bravitz, I'm Jonathan Ferro. Futures are lower, bonds are bid, commodities are softer, and later, massive testimony on Capitol Hill with Chair Powell and Secretary Yellen. This is Bloomberg.
With the first Fed News, I'm Rishka Gupta. In Boulder, Colorado, police say a gunman opened fire at a crowded supermarket and killed 10 people. One of the victims, the first police officer to arrive. One man has been arrested. Police haven't named the man or discussed a possible motive. It's the 7th mass killing this year in the US. Last year had the smallest number of such attacks in more than a decade. Health experts in the US are again sounding the alarm about the resurgence of the coronavirus in some regions. They're especially concerned about the role of variants are playing in states such as Michigan and New Jersey. The resurgence could diminish the benefits of the widespread vaccination campaign. After last week's contentious meeting with the US, China is looking to improve relations with Russia and North Korea. According to the state-run news agency, Beijing says it's willing to work hand in hand with North Korea to develop its relationship. Meanwhile, Russian Foreign Minister Sergei Lavrov visits Beijing this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds at the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I see a couple of tailwinds building, one of which could be the government needing to put in more austerity, needing to find a way to pay for all of this spending. I think the pendulum could swing the other way, and that's just one thing that could bring growth crashing back to trend.
Lara Raim there, FS Investments chief U.S. economist from New York City this morning. Good morning. Alongside Lisa Bravitz, I'm Jonathan Ferro. Tom Keene out all week. Here's the price action this Tuesday as we count you down to testimony with Chairman Powell and Secretary Yellen. Take a look at the bond market. Yields in 7 basis points. A break of 163 at 162.76. Into the equity market. Equities lower by 0.4% on the S&P and mildly lower on the Nasdaq. Your underperformance from the Russell this morning. In foreign exchange, the Aussie is where the underperformance is. The Aussie weaker off the back of what's happening in the commodity market. So let's sit here just for a moment. WTI with a 59 handle. We had a break of that briefly. A move of 3.9%. A source of mine out of London telling me to take a look at our reporting out of China. So a source of mine telling me to look at my colleagues reporting out of China, so I'll do that right now. China considering the sale of about 500,000 tons of aluminum from state reserves. This is according to a person with knowledge of the plan, and this all about really pulling back demand for the highly carbon-intensive metal, Lisa, and hitting emissions targets, and that's the story around here. Over in China, the emissions story and the bleed across from, say, maybe the metals market, because we have both aluminum, forgive my pronunciation in London, I'm doing it the American way, I'm in New York, copper down by about 1.2% as well, and commodities down too more broadly.
Yeah, aluminum. I'm always trying to pronounce it the British way.
Do you want to do that now? We can avoid that now.
I can't do anything.
Carry on, Lisa.
It's great. Yeah, we'll avoid that. All right, but I do think there's also another question about China and how they are transforming their economy. It is a maturing economy away from some of the infrastructure push that led to more than 100 bridges and roads and all sorts of buildings being developed, to something more sustainable that isn't driven as much by spending. And you do wonder how that affects the commodity complex on a growing basis, especially as they try to delever the economy. So this sale really highlights that transformation underway, John.
That's the story right now out of China. Let's talk to Kevin Cirilli down in Washington, D.C., our chief Washington correspondent, on the conversation around China and how it shapes U.S. policy. Here's the line from the president. This is what he told lawmakers in a pitch for his infrastructure proposal just after he spoke with the Chinese president. If we don't get moving, they're going to eat our lunch. We just have to step up. Kevin, is that what shapes a bipartisan infrastructure approach? And I talked to our colleague a little bit earlier this morning about this, whether it's industrial policy first, America first, that really drives some of this.
Yes and no. I think the biggest difference in terms of infrastructure is the idea of how to pay for it. But on the bedrock and the foundation as it relates to national security, there is widespread agreement across not only the agencies and the various departments of U.S. government, but also amongst Republicans and Democrats. Yesterday, we should note that major headline that crossed that Politico broke in terms of how the UK, EU, and United States were going to be issuing sanctions against Chinese officials for their involvement in the human rights abuses against the Uyghur Muslim minority groups in the Xinjiang province. But I mentioned the Xinjiang province as a broader whole, John, because whether you're talking about rare earth minerals or whether you're talking about global supply chains or a chip manufacturing shortage, that particular region has a dominant role to play in the geopolitics of the domestic manufacturing moment.
So, Kevin, fold that into the equity relief story that we've seen so much of over the last couple of months, particularly from this administration. Are we going to see two separate bills or one monster bill? Has there been a decision about that?
There has not been a decision about that, but what I can tell you is that the various committees are already trying to lay the foundation for a piecemeal approach. But whether or not that ultimately gets done, I don't know. If you're a Republican, a piecemeal approach candidly would look a little bit more potentially approachable in order to tackle, because you're talking about several trillions of dollars, and the appetite for that and the window for that is quickly diminishing, especially if you're trying to pass it about a year out from midterm elections.
Is that the message, Kevin? I mean, I was surprised, frankly, that we didn't see more of a boom in certain equities in the heels of this $3 trillion proposal for infrastructure spending from the Biden administration. And I'm wondering if that's the message, that it's unlikely that this will get done, that this is a wish list more than a plan that actually is passable.
Yeah. Bingo, wish list. It's a total wish list. And Lisa, look, I think, again, I hate to say this, but it bears repeating. If you're talking about cyber infrastructure, if you're talking about laying a concrete plan in order to better protect from a national security perspective and to some extent from an energy resource perspective, fine. But there's still a lot of divide, again, on chief among them, how to pay for it. And you've got Democrats saying they want to raise taxes. You've got Republicans saying no way, no how, they're not going to budge. And play this forward. If you subscribe to the notion that Republicans will win back control of the House of Representatives in 2022, then there's no way that a major tax overhaul would be able to get done and that the corporate tax rate would be able to increase. So the window for progressives in order to raise taxes, especially that corporate tax rate, it closes with each day that gets closer to the midterm elections, though I know we're still a year and a half away from that.
So what parts, Kevin, of this bill, of this proposal, of this wish list are real, are going to get done and going to get done as soon as possible?
I think when you talk about cybersecurity, I think when you talk about digital infrastructure, I think when you talk about bolstering some rural as well as some more urban communities from a cyber perspective, I think that there's widespread approval for that. But again, like a total pork package of roads and in certain towns that many Americans haven't heard of, that's unlikely.
Kevin, always great to see you. Never too early to talk about the next election. That's always the story for the policymaker in the seat. Isn't that Operation Politics? Keep your seat, Kevin?
Yes, and how do you say, I was trying to work it into my head, aluminium? Aluminium. There we go. I'm getting there.
You're getting there. You don't need to learn it. Don't worry, Kevin.
Me too.
Kevin Cirilli, Chief Washington Correspondent, hosts the Sound On Bloomberg Radio weekdays at 5 p.m. Eastern. One of the only things we script on this program is that tease for Kevin's radio show a little bit later. Let's talk about this bid into this bond market. Yields are in 6 basis points, 163 on US 10s, in about 5 basis points on 30s to 235, Lisa. Yields come in as we're set to hear from Chair Powell and Secretary Yellen a little bit later this afternoon.
There are some technical factors that I think are underappreciated. And really this note out of Nordea I thought was fascinating, talking about how if you take a look at an FX-adjusted basis, yields in the United States are the highest they've been for Japanese investors since 2015. Earlier, you had Japanese investors pulling back because yields were looking low relative to other areas on a currency-adjusted basis. That has shifted on its head. So you have to wonder, that foreign buyer coming back, how that actually drives yields. yields down and create some support ahead of this $206 billion of Treasury auctions this week.
A lot of supply this week. Lisa's run you through the slate. I'll do it again. A little bit later today, we have $60 billion of two-year notes. Then tomorrow, $61 billion of five-year notes. Then $62 billion of seven-year notes. Coming up a little bit later this week, and a ton of T-bills in between, no doubt. From New York City this morning, good morning. Coming up, Michael Kushner and Morgan Stanley fixed income CIO on this bond market with yields lower, commodities lower, the Aussie weaker, the Euro weaker, the dollar stronger, and equities with a mild move of about 12 points south on the S&P. We're down a third of 1%. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City for our audience worldwide, good morning to you all. Live on TV and radio, this is Bloomberg Surveillance, and here is the price action. The story's clear. 12 months on, huge snapback. but the leadership has changed more recently. It's about value over growth now. This morning, what we have is outperformance from the NASDAQ and big tech, underperformance from the small caps and a Russell. The Russell down by a little more than 1%. The NASDAQ doing nicely there, firmer by 0.1%. Nicely, relatively speaking, and largely off the back of what's happening in the bond market. Big bid into treasuries we'll discuss with Michael Kushner and Morgan Stanley in just a moment. What have we learned in the last 12 months? That you want to get ahead of the recovery. That's what's been happening in Europe. Switch up the board. Travel and leisure stocks have been leading the way. They've been at all-time highs in Europe, even with the difficulties that we've had on the continent. Those difficulties get more pronounced. That particular part of the market is down about 1 percentage point over in Europe, but you look within it, the likes of IAG, the parent company of British Airways, down about 4 percentage points this morning, off the back of renewed concerns over the pandemic and extended lockdowns in places like Germany. So you see it being priced into the equity market for travel and leisure stocks on the morning, but not through the year. On the year, what you have seen is this one move. Switch up the board and finish on euro-dollar. Euro weaker, dollar stronger, came into the year with huge enthusiasm for everything but the US dollar, huge short position, then ate into that as the year grew older. Right now, 118.80 and down about 0.4% on the session. But a story I keep revisiting right now. Peak pessimism in the continent, peak optimism in the United States of America. Forecast through the roof, boom year coming, everything lining up for a stronger dollar. Where have we seen it? We've seen it against EM over the last couple of months. We haven't really seen it against the euro. Where were we at the start of January? 123, right now, just south of 119. You'd expect that one, I think, to be moving a whole lot lower, given the trajectory for growth differentials in America versus Europe. And I think you have to respect what the market is telling you, that it's struggling to move a whole lot lower, even with the incremental bad news out of Europe and the incremental good news out of the United States. And I think for that reason, this is one we have to keep asking questions about. Why? Why haven't we had a bigger break of the euro at 118.80? We'll talk more about that a little bit later. Let's get you some movers. Here's Taylor Riggs.
John, I have to say happy anniversary. It's not your and my anniversary. It is the anniversary of the market. 1 year ago today, the markets bottomed out and we ended what was the fastest bear market and began the best first year of a bull market ever, if you can believe it or not. So I just wanted to throw up some stocks behind me that show everything that was up more than 100%. It really is those stay-at-home stocks, right, John? You think Peloton, I still can't get my hands on one. Zoom, everyone in but us in TV are doing Zoom. And then, of course, Chewy's, we all adopted pets when we were staying at home. And then finally, Disney, arguably one of the best launches to a streaming service ever. So these are the stocks that have been really the big winners in the last year. But let's get back to the action today. We flip up the board and take a look at some of the intraday winners and losers today. Microsoft, they're looking at a $10 billion deal for Discord. Viacom selling shares to help fund operations. That's a theme that we've seen all year long. We take a look at American Airlines as well, part of a travel group that's asking Biden to lift some of those international restrictions by May 1. I certainly would be traveling without restrictions. John, GameStop. Can you believe it's only my second day on the show and I'm still talking about GameStop?
You know what's interesting, Taylor? I don't know for you guys, but we've hardly talked about the company itself and corporate strategy through the whole episode. It's been remarkable. Yeah. We've just talked about the speculation around it, but nothing to do with the fundamentals. And a little bit later, I know you guys will be on top of that.
Yeah, we're going to be doing some earnings after the bell. Now, of course, valuation's totally disconnected from reality, but we are looking at changes, of course, from an activist investor who was the co-founder of Chewy. He's leading the shift to digital, John, and so that really is the focus. And if that shift to digital can go fast enough, you mentioned some of the management changes at the top of the hour, so we'll be looking at, well, management, but really, can they do the digital? Can they become the next Amazon? Can you buy video games online instead of in store? We'll be doing GameStop and then maybe the retail angle, but don't kill me.
The next Amazon is a big, big call there. Taylor, thank you. On the close a little bit later this afternoon on Bloomberg TV alongside Caroline Hyde. I believe Romain Bostic is out this week as well. Taylor, thank you very much. Let's turn back to this bond market. Fascinating move. Lower, not higher for once. Yields, a break of 175 last week. This morning, in and around 162, 163 on 10s. Joining us now, Michael Kushner, Morgan Stanley Global Fixed Income CIO. Michael, I won't ask you whether we have hit the limits on the upper end of this sell-off for yields to go higher. I will ask you the process that you would go through to identify whether we have met that moment, the signpost you would look for to identify whether it has exhausted itself. What would you look for?
I would look for sustainability of the economic
recovery / boom that we're having right now. I think that there was the sell-off we've had so far is perfectly logical and rational given the surge in growth expectations and the dovishness about the Fed of not taking the punch bowl away before the party started. So that surge of interest rates we saw at the beginning of the year to now, given the information flow and data flow we've gotten, seemed very reasonable. But at some point, that is processed. I think around the 175 level is the market's process that information. Plus, as you mentioned earlier, that the U.S. bond yields on either outright or a currency-adjusted hedged basis are very high by global standards. So I think that we're now looking for the next bit of information in terms of where we're going to go from here. Real interest rates have moved higher, but will they stay higher? Will the world post-2023, outside of the Fed's forecast horizon, look like a new age has come about, or are we going to just go right back to where we were, in 2016, 17, 18?
No doubt Lisa will want to ask you a couple of questions about foreign demand for some of the issuance coming this week, but let's just sit on what you talked about, which is basically the D word, deceleration. We're going to hear a lot of that word being used through the summer and into the back end of this year, Michael. If you look at the Fed's call, 6.5% for GDP growth 21, 3.3 22, 2.2 23. What's the degree of deceleration out of 21 into 22 into 23 that you and the team at Morgan Stanley anticipate, Michael?
That pattern is pretty reasonable. If you look at longer-term growth trajectories, inflation expectations through the TIPS market or just through the swaps market, there's no real change in long-term inflation expectations. We have this inversion in the break-even curve in the TIPS market. It's not suggesting that the market is convinced that the world is changing longer term. We're going to have a very boomy economy for a while, then it's going to settle back into normal, and that trajectory does not look unreasonable. So if growth is peaking, everything's peaking now, inflation's peaking in the next 12 months, why should interest rates go a whole lot higher?
But at the same time, some people say, why should rates right now, 10-year yields, be below the longer-term expectation for inflation, which is above 2%, right? And so this is sort of the conundrum. Can we get negative real rates for a prolonged period of time? And what does that imply? And I do wonder, talking about foreign investor demand, is this because at this price point and given where the currency is, Japanese investors will start flooding back in and provide a bid for treasuries at this level for the foreseeable future?
It's a good question. We've already seen the Bank of Japan talk about loosening their yield curve control, allowing 10-year yields to move around a bit. If they do that and let Japanese yields rise, and they actually do rise, that again reduces the incentive to move to the United States. So we're seeing around the world adjustments, emerging markets in particular, yields moving higher, currencies becoming a bit unstable, and central banks raising rates in several countries. So it's, I think, a very uncertain time, but there's no doubt that the foreign demand for U.S. fixed income, whether it's treasuries or investment-grade corporate bonds, is very important. And I think one of the reasons why yields rose as fast as they did was that those investors stepped away because of volatility in the market, saying, we'll just sit back and wait, see when they peak or get to a more even higher level and step back in. So I would expect them to step back in at the margin at these yield levels, particularly because volatility looks like it's subsiding.
Do you think that we're going to see another bout of volatility similar to what we saw a couple of weeks ago this Thursday with the 7-year auction upcoming, especially in light of the fact that there's been that change in the regulatory exemption, the SLR exemption, and banks may be more reluctant to provide a buffer and buy some of the treasuries in the auction?
We don't see that. It's certainly possible. It's another wild card into the actual absorption process of auctions. But I think banks have lots of things they can do to adjust their balance sheets and adjust the SLR holdings in order to accommodate the short-term needs of the deal with the auctions. Plus, the primary dealers have to buy the bonds. That's their job, and they will make other adjustments to take it down into their balance sheets, at least temporarily. But the foreign demand looks like, I think, it will recover and will come back at the margin. We'll see how much it does. But again, if growth is peaking, the market's priced rate cuts in 2023 when the Fed has said, no, we're not going to do that. It looks like we're going to have to get stronger data to dislodge the Fed or to get people to push real rates back towards zero at least.
So, Michael, let me put you on the spot. Are you a buyer of Treasury yields on backups to 175, or are you still avoiding that story?
I think right around here, yes. We were more interested in buying than selling at these levels, yes.
Okay.
Slightly higher.
Very diplomatic there, Michael. More interested in buying than selling. Michael Cushman, Morgan Stanley Global Fixed Income CIO. Your 10-year right now, 164, yields in about 5-6 basis points, Lisa, a bit into this bond market.
Yeah, the uncertainty, though, that Michael Cushman was talking about is really important. And I do want to sit on that. This idea that emerging market nations are raising interest rates. We saw that Turkey, of course, is its unique story with the recent ouster of their head of the central bank there. But they're not alone. And this is the story, is tightening policy after decades of ultra-low yields around the world, or at least in the developed world. And you do have to wonder, are we entering a new cycle where yields can creep higher because you don't have a global race to the bottom? John, that's a huge shift.
And a new fiscal impulse as well. I think that's got to be the biggest shift, Lisa. How permanent is that fiscal impulse? Is it something that stays with us beyond 21 into 22 into 23? Can that story hold? And that comes down to politics, and that comes down to elections, which is why we should continue to have that conversation with Kevin down in Washington.
Yeah, although I will say this, you are getting more people talking about how to pay for it. And the more people talk about how to pay for it, the more this seems like a temporary impulse, right? And that's the reason why you've got some of the Democrats trying to get through a plan as quickly as possible before people lose sight of what just happened, because otherwise the fiscal hawks, I don't know if you really
the fiscal hawks. I haven't seen a fiscal hawk in power for a long, long time. Usually it's when they're outside of government that they become fiscal hawks. For me, what's really interesting, Lisa, at the moment is how the market responds to the conversation in Washington. And the bias is really clear. Very, very interested in the spending, not listening just yet to the tax hikes. And I wonder when that comes on the radar in a more pronounced way. Maybe in the next several months, I have no idea, but that's just where the bias is at right now. Focusing on the good stuff and maybe not so much on the other stuff and what it could mean for this market down the road. From New York City this morning, good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. The state of things as follows. Yields at 164 on 10s. Equities in 11 points and down a third of 1%. Testimony on Capitol Hill a little bit later. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. For the second time in less than a week, there's been a mass murder in the U.S. Police say a man with a rifle opened fire in a supermarket in Boulder, Colorado, killing 10 people. One of them was the first police officer to arrive. One suspect has been arrested. Last week, 8 people were killed in a mass murder in Georgia. Treasury Secretary Janet Yellen and Federal Reserve Chair Jerome Powell will get a sense of how concerned Congress is about inflation and the deficit. They'll begin 2 days of congressional hearings today. Republicans blasted the pandemic relief bill as excessive. Now President Biden is on the verge of proposing a more expensive bill to fix the infrastructure. The Biden administration is taking part in a climate summit co-hosted by China today. That comes just a few days after the two countries squared off in their first face-to-face meeting since Joe Biden took office. China's responsible for about 30% of the world's greenhouse gas emissions. And after the bell today, GameStop reports earnings for the first time since it became the poster child for meme stocks. But those results may not matter as much as its effort to recast the brick-and-mortar chain into an online merchant. Shares are up more than 930% this year. GameStop's hoping to attract gamers online to make purchases. The company has already closed hundreds of its stores. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We are at a critical point in this pandemic, a fork in the road, where we as a country must decide which path we are going to take. We must act now, and I am worried that if we don't take the right actions now, we will have another avoidable surge, just as we are seeing in Europe right now, and just as we are so aggressively scaling up vaccination.
That's the warning coming from the CDC director, Dr. Rochelle Walensky. We'll talk about that warning in just a moment. From New York City this morning, good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action as we count you down to testimony from Chairman Powell and Secretary Yellen a little bit later. Equity futures come in about 1/3% and down 10-11 points. Bit into the bond market, yields off the lows of the session, still lower. We head down by about 5.5 basis points to 164 on 10s. Talked all through the morning about this move lower in commodities. 59 handle on WTI, 59.31 and in about 3.65%. Euro weaker too, euro dollar 118.81. Underperformance is coming from the Russell, the small caps, outperformance from the Nasdaq. Nasdaq 100 futures now positive by almost 0.1%. Can we just revisit that just a second, Lisa? Just that comment from the CDC. We must act now, and I am worried that if we don't take the right actions now, we will have another avoidable surge, just as we are seeing in Europe right now, and just as we are so aggressively scaling up vaccination. Is that a warning just because there's worry there, or a warning underpinned by the data that really justifies that level of alarm?
Well, there is the data that is creeping higher. You're seeing hospitalizations tick higher in certain places, New York and New Jersey among them, and you're seeing the case count increase, especially as these variants continue to spread south of Florida in particular. This, though, goes to what Dr. Amish Adalja was talking about, this sort of toggle between allowing people to live their lives a bit more as the most vulnerable individuals have already been vaccinated. So you're actually preventing the most harm versus perhaps ending the pandemic sooner. And I think that's the question. Do you have to vaccinate a greater proportion of the overall population to get to herd immunity if you have these variants circulating more aggressively? That's a big concern for health officials.
Let's bring in Professor Lawrence Gostin at Georgetown University. Professor, it's always great to catch up with you, sir, and just run through some of these issues. I'll talk about what I think normal people feel like right now. I feel like they have the fear of God put into them over the last 12 months, particularly a year ago around this time. And the more and more they hear warnings like that, I think increasingly they become desensitized to them, Professor. Is that kind of level of alarm justified by the data that you see?
You know, I do think that Dr. Walensky's right, the head of the CDC. I mean, we're headed in the next, I would say, 4 to 6, maybe 8 weeks for a perilous period, because you've got a combination of enormous pandemic fatigue. So people are just they're completely fed up with it. They don't want a mask. They don't want a distance. They do want to go to restaurants. And you're also seeing variants that are taking hold in the United States. In addition to that, governments, states, governors, cities are taking down their mask mandates and removing them. And so that combination of factors does worry me for the foreseeable future, 4 to 6 to 8 weeks. But I have to say, after that, I really think we're going to be starting to move out of it. And public health officials shouldn't understate the importance and the value of vaccination. It can get us back to a very near point of normal by late spring and certainly by the summer. These vaccines are incredibly good. They prevent hospitalizations and deaths almost by 100%. And that's really good news. So we should just hold on there for a few more weeks, and I think we're going to be in really good shape.
Do you think we've got a messaging problem at the moment, Professor?
I think we do. You know, I mean, in a way, you know, I understand my colleagues, raising the alarm. I just did too for the next short period of time. But, you know, it's the boy who cried wolf too often. And I think if we can make it very clear that these vaccines can get us to a really, really good place, but until we get a sufficient number of a population that it's vaccinated, we're still in a good deal of trouble, and we still have a lot of mutations of the vaccine, so it could, create a dangerous, significant variant in addition to that. But I do think we need to change our messaging to one of hope. Just hold on, and things are really going to be a lot better.
Dr. Gostin, the concept of the proportion of the population that you need to vaccinate in order to get to herd immunity is where I wanted to go. How much does that proportion increase as these variations get hold and people go out and party?
Yeah, that's a really good question. The truth is that, to the extent that the variations, the variants actually create greater transmissibility, the higher the herd immunity level you're going to need in the population. The truth is that, herd immunity has become a cult term now. And really what we want to do is just vaccinate as much of our population as we can so we can break those chains of transmission. We want to do it as soon as we can. And so I do think that we really want to try to roll this vaccine out to younger and people in our population so that we can really, really get a hold of it. But we're in a battle. We've seen, this is one of the most wily viruses I've ever seen. And you just have to sit back and look at Mother Nature and say, I really do respect you. You're pretty powerful. But our vaccines are powerful too.
Yeah, Dr. Gostin, I think everybody has new respect for Mother Nature. There's also a question about messaging around the AstraZeneca vaccine. AstraZeneca coming out and saying that the numbers that are being called into question by U.S. health officials is based on data where the cutoff was of February 17th. They say that they're going to issue results of primary analysis within 48 hours. What do you make of the confusion around AstraZeneca?
I'm just wondering about that company right now. I mean, if you remember back, the confusion when they first put out their clinical trial results, and they said that a single dose was more effective than a double dose, and the clinical trials were designed as a double dose, so that baffled public health experts. We just didn't understand how the company could be cherry picking its data. Then it had the fiasco in Europe, which I don't know that it was their fault, but the halts in the rollout with AstraZeneca vaccine due to reports of blood clots, which the European Medicine Agency said really was not causally related. And now this, why would you come out early and announce with fanfare your clinical trial data in the United States, and then a day later have the National Institutes for Health rebuke you? That's very unusual.
Is it unusual for Dr. Fauci to say the same thing without going through the data first?
Well, I know Tony well. I think Tony is pretty big.
Okay. Professor, we've got to let you go. It's got to catch up. University of Georgetown University, Professor Lawrence Gostin there from New York City for our audience worldwide this morning. Good morning. This is Bloomberg.
just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. Having the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
To a place like this and be able to break some stuff and release some tension without going to jail.
How can somebody remember things that happened 80 years ago? How do you do that?
David, it's easier to remember 80 years ago than what I had for lunch today.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The public is still engaged, volumes are still heavy, flows are still strong.
You have enough going on this year to push the economy well above potential.
It would be a mistake to assume that the U.S. is now China and can sustain growth at these astronomical levels.
It's just not there. I don't think the Fed's ever going to see runaway inflation.
The economy and the stock market don't always go in unison. This seems to me to be a year in which Main Street beats Wall Street.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
2.49 million from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. Tom Keene back with us on Monday. Lisa, let's start right there. 2.49 million. That is your average vaccination rate in America over the last 7 days. You throw in another monster relief plan down in Washington. On top of that, a chairman that is willing to sit this out over the next couple of years and not hike interest rates. And that's the scene set for you down in D.C. today. A big effort, a unique moment.
A unique moment, a big effort on all accounts, and you have to wonder why we're not seeing more of a rally in equities on the heels of all of this, and that goes to the fatigue. Yes, we know we're almost there. Yes, we know we're going to get more spending, although I think there's some doubt about the $3 trillion plan and how realistic it is in the near term, and yet that's being baked in, and now what? Now we need to see the proof, and now we need to reopen, and people are just exhausted.
Deceleration, what does it look like? 21 to 22 to 23. I don't think that's on the radar of the equity investor just yet, Lisa, though it may increasingly be on the radar as this year grows older, but it is in the bond market. This is what the likes of PGIM, BlackRock, and others, everyone in fixed income that we speak to on a weekly basis are thinking about beyond 21. What's the deceleration into 22, 3 and beyond look like? What's trend growth like in that world? Is the boom reminiscent of anything we've seen before? maybe you have to go back several decades, but the years after that, is it familiar? Is it like the previous cycle? Low growth, low rates, low inflation. Do we return to that again?
Well, and how do you even game that out at a time of fiscal policy uncertainty? And I talk about that $3 trillion plan that was being proposed and talked about. That's a big number. That's much bigger than some people had expected. I was really surprised to see no market response or very little. And Kevin Cirilli summed it up. He said, it is a wish list. It is not going to get done, certainly not on a bipartisan basis by any means. The question is, let's say we do get infrastructure passed. Let's say we get a comprehensive bill. How does that filter into markets? Where is that not being priced in? Or are people already hoping for something that's unlikely to get passed? And that fiscal policy uncertainty, to me, I can't remember the last time it was this big.
Well, right now in the bond market, things look okay. Yields are in 5-6 basis points on 10s. They look okay right now before you start sending me the hate mail about the last couple of months. I get it. Let's get to the price action at the moment. Equity futures come in on the S&P 500. Did I sound a little bit delicate and sensitive then? Maybe. We're in 14 points on the S&P. Just stop sending it in the bond market. Yields are in 5 basis points at 164 on 10. Send it to Tom. Yields are in. The commodity market's lower. Crude's down by about 4.5% on WTI. 58 handle on WTI. Metals, crude, lower, softer. In the FX market, the Aussie weaker as well. The Euro weaker, 118.83 and down 0.4%. A defensive posture, Lisa, this Tuesday.
Defensive in both stocks and bonds, which is interesting. Are we seeing some sort of shift where bad news is bad news once again, John?
Let's bring in Anne Maletti, Wells Fargo Asset Management Head of Active Strategy. And talk to me about this moment we're in for active management, for the rotation, and help me understand whether it's just a moment in time or something that can endure beyond 21, into 2, into 23.
Well, Jonathan, I think it's a great question. Certainly, we're going to see a lot of strength in the economy. Like you mentioned earlier, that surge is going to cause earnings growth in several companies, but it's not going to be across the board. And this is where I think active management can really play a role, where fundamentals are going to matter. The dream is the dream, but now it becomes the reality. And so who can really capitalize on building cash flow and earnings? And those will be the companies that are rewarded more in the next cycle.
Give me a better understanding of your process then, your approach right now to bottom-up analysis and stock picking, Anne. What do you look for?
Yeah, so certainly, we have portfolio managers and investment teams that have value focus and growth focus, emerging markets, et cetera, across the board. But I would say that instead of focusing on value or growth, what they're focusing on more is cyclicality and secular trends. And those are really what's changing almost on a daily basis, the leadership of the market. Certainly, the recovery in GDP is pushing that secular trend that we're seeing in value in small cap stocks. But the cyclical trend, but the secular trends are really driving what we're seeing across almost every industry. Innovation really has led the way, especially over the last year, and it's going to continue to be an important driver for earnings and cash flow for all industries.
So you talked about basing some of the purchases on fundamentals, and it's Philosophy Tuesdays. I'm going to dub this as Philosophy Tuesdays. What are fundamentals at a time when so much is being driven by policy, whether it be fiscal or monetary?
Fundamentals really are how companies are investing for the future. And certainly capital has been very, very cheap. That liquidity has made it possible for almost every company to survive this past year, but also for them to do relatively well in the marketplace. But now there's going to be some separation of winners and losers. It's who has focused, taken that liquidity and invested it for the future, and who's going to continue to do that. If you don't invest for your future, you're going to die. And that's what we've seen. That's what we're going to see more and more. Just innovation trends continue, digitalization continues, and all the companies almost across the board are going to have to invest.
And do you think that the market is accurately picking up on the companies that are investing well in their future? And I'm saying this at a time when we're expecting GameStop to come out with earnings. And yeah, they're expected to not lose money for the first time in a long time. And yet people might argue that might not be enough to justify the tremendous rally that we've seen. I mean, is the market acting efficiently?
You know, Lisa, I think it's fair to say we're seeing some very strange things. I mean, certainly in my 30-year career, I have not seen some of the things that I've seen over the last, 6 months, even over the last year. So there are inefficiencies in the market. And whenever you have this much stimulus thrown into the market, you're going to see things happen like we're seeing today. But what's really driven the market over the last decade is all of this stimulus. It's almost like everyone can survive because capital is so cheap. That trend has to stop at some point, and that's when fundamentals really will matter. And quite honestly, they still have mattered for the most part. Investors are focused on cash flow, they're focused on earnings growth, and that's going to become more important, especially when we get to a rising rate environment. Those are the companies that need to produce earnings. If you have a high multiple now, it might be okay as long as you can rapidly grow your earnings.
And before we let you go, I want to finish where we started. I think you did a brilliant job there of taking us away from growth versus value to focus on the cyclical aspects of this market and the more secular aspects of this market as well. Some people might go another step further. The cyclical story is a story for me to buy and hold on a short-term horizon, and the secular story is something longer time horizon. And I'm trying to understand for you, Anne, whether there is a cyclical story that you'd like to hold beyond just, say, the next 12 months.
Yes, I think there are. There are several industrial companies in the manufacturing space and other places that are benefiting both from the cyclical trends, but also the secular story. We have manufacturing coming back to the U.S. We need to build more in the U.S. That started, over the past 4 years. That's going to continue into this presidential term as well. And so the secular and the cyclical can emerge in a lot of companies together, and that can last, and that could create a cyclical story that lasts much longer than we've seen in the past.
That's the one I think we need to talk more about. That could get really interesting in the year ahead. And it's great to catch up. Come back soon. Love to catch up. Anne Milletti, Wells Fargo Asset Management Head of Active Strategy. Lisa, let's just sit there for a moment. This is when industrial policy is absolutely critical down in Washington. How do you take some of that cyclical exposure and start thinking about it beyond just the mechanical reopening of this year? How is it supported by policy beyond 21 into 22 into 23? And when you hear about infrastructure and industrial policy, they're the themes that I think Anne was getting at near to the end of that conversation.
But policy uncertainty weighs in on this, and that's why I keep reiterating that, because it's unclear what will get passed, where the money will get directed, and how much of the supply chain will get brought back to the United States for a variety of reasons. And so, these are where there could be a sudden boom or an unexpected explosion of certain industries that people perhaps aren't seeing right now. And I wonder how much people are gaming that out from some of the plans that are being outlined by the Biden camp, especially given the fact that there is not bipartisan support for them.
You started to sense a few more doubts coming into the cyclical trade over the last couple of weeks from various houses on the South side.
Very much so. I mean, people are basically saying perhaps we've bid too much too quickly, especially given the fact that we're going back to that sort of low growth trend. I think people also are just uncomfortable at valuations here, especially if yields are going to rise and if they're rising around the world. And I think that's fair. I mean, we've brought forward so much growth over the past, 12, 14 months based on hope, right? Not necessarily the reality of the data. And as we get the reality of the data, a lot of people are saying that's when we'll get either confirmation or that's when you start to sell.
Mr. Kaplan from Dallas, here's a headline for you, Lisa. Not at the median in the dot plot, more aggressive on the rate hike. For anyone that's heard the Dallas Fed president come on this program, this won't be a surprise. He said he's among the Fed members advocating for a 2022 rate increase. There is division at the Fed. I think it's worth talking about that, Lisa. There is division. The median dot tells you one story, but there is division. And I wonder what that division looks like increasingly as the year grows older and that data really starts to kick higher for CPI, for growth. Seeing it is very different to forecasting it.
Financial stability. That, to me, I think will be the big divide. Who's worried about it and who's not?
Well, the Dallas Fed president has clearly come on this program multiple times and signaled some worry about it. From New York City this morning, good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene back in the building next Monday. Yields are in 5 basis points to 164. Equities are down 1/3% on the S&P 500. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. For the second time in less than a week, there's been a mass murder in the U.S. Police say a man with a rifle opened fire in a supermarket in Boulder, Colorado, killing 10 people. One of them was the first police officer to arrive. One suspect has been arrested. Last week, 8 people were killed in a mass murder in Georgia. President Biden is beginning the push for his next multi-trillion-dollar spending bill. This one is centered on infrastructure. He's betting it will do more than just boost the economy. The president told members of Congress it could ensure U.S. competitiveness against China for decades to come. And another setback for AstraZeneca's coronavirus vaccine. Health officials indicate that promising results in a U.S. trial may give an incomplete view of the shot's effectiveness. The company said the shot was 79% effective in the trial, but an independent panel expressed concern that the results included outdated information. AstraZeneca says it is completing validation of its analysis and will engage with the safety panel. And after last week's contentious meeting with the U.S., China is looking to improve relations with Russia and North Korea. According to the state-run news agency, Beijing says it's willing to work hand-in-hand with North Korea to develop its relationship. Meanwhile, Russian Foreign Minister Sergei Lavrov visits Beijing this week. And Citigroup will begin having Zoom-free Fridays. According to a memo from CEO Jane Fraser to employees, video calls will be banned on Friday, at least for internal meetings. Fraser also encouraged workers to take vacations, and she designated May 28th as a firm-wide holiday to be known as City Reset Day. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Percent of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
begins with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
If real yields start to go much higher into positive territory, then you better have strong growth and you better have the inflationary pressure. Otherwise, it's going to have an impact across all asset classes.
It's had an impact over the last couple of months. Bob Michael there, JP Morgan Asset Management Chief Investment Officer and Global Head of Fixed Income. We've been talking about these headlines coming from the Dallas Fed President, Mr. Kaplan, seeing a 10-year Treasury rising further to 175 to 2%. That'll be helpful. In the bond market right now, here's your 10-year. It looks like this on a Treasury. Yields coming in about 4 or 5 basis points on 10s. Yields about 164.88. In your equity market, we come in 1/3 of 1%, 39.17 on S&P 500 futures. Talked all morning about the softness, the weakness, the move lower in crude, down by almost 4 percentage points there to $59.11. Lisa, what do you make of that? A headline from the Dallas Fed President seeing the 10-year Treasury rising further to 175 to 2%.
There's a question here of where his concern lies. Is it in inflation? Is it in tightening financial conditions? Or is it in financial stability? And he's raised issues about financial stability, the froth in markets, and the concern of what it means for them to hold their low rate policies for a long time. If he sees sooner rate hikes, perhaps that long end is what he will be looking for to justify that view. And so that's what I make of that 2% call of his.
I know a lot of people will be screaming a non-voting member, but I do think it muddies the waters ahead of Chairman Powell a little bit later. He's not an advocate of monetary policy to affect the Treasury curve. Just some of the headlines coming from the Dallas Fed President. If you missed the segment just before this one, expecting to raise rates in 2022. That's his view, not the view of the committee right now, if the median dot is anything to go by. We spent this morning talking about monetary policy, fiscal policy, the kind of things we always do. We've also talked about looking back 12 months and the lessons learned in the equity market. I think we need to do the same in credit now, and we've got the perfect guest to do that with Don Mullen, Pretium CEO and founder. Don, let's start there. The look back 12 months, the lessons learned, how resilient credit's been compared to what you expected. What was the big lesson for you, Don?
I think the big lesson that we learned is that when the Fed decides to do credit QE, which it really did the first time in this crisis where it made a decision to invest in investment-grade bonds, it would have a dramatic effect all throughout credit. And that as a result, don't fight the Fed, a common phrase in the past, was more true this time than ever before, particularly when you pile on fiscal policy, which was extraordinary this time around. I think the challenge, referencing some of your other comments, is that I think strong expectations of high GDP growth for the latter half of this year and going into next year are consensus, but people aren't sure how that's going to be spent. And so the ability to understand valuations in credit and valuations in the equity market, as well as the fact that so many companies have different balance sheets today than they did in 2019. No one knows which companies will be the ones that don't benefit. And so there's a challenge right now in credit markets. What's the right narrative structure? You know, how will movies recover? How will gyms recover? Do they have too much debt? Do they have too little equity? Because nobody knows what the new normal is.
That's true in both stocks and bonds, and you're seeing in stocks people starting to question the cyclical trade. I'm wondering if you're seeing a similar move in credit, this idea that it's been so good and it's been backed by a really easy Fed that's now second-guessing some of its policies and how applicable they are to a future that looks brighter. I mean, basically, are you starting to get more cautious on credit from here?
Well, I think we're going to see a trader's market rather than an investor's market. And so less beta, more volatility in credit. We'd hope to see some dispersion. There certainly should be more dispersion in the lower quality and the smaller cap names where capital has a harder time accessing, with all the large numbers of money managers all raising huge amounts of opportunistic capital and distressed capital. We think the larger names are certainly priced to perfection. And so more of the inefficiencies are on the bottom parts of the market, of the smaller sizes. But yeah, we're going to see a lot more volatility in credit spreads as the narrative develops. As I said, we don't really know where the consumer dollars are going to be spent. We know clearly they're going to be different than they were in 2019. And so as a result, we see opportunity coming, but I think it's the early days of opportunity. In this nanosecond, in this moment, I think we're priced closer to perfection, but I see opportunity on the horizon.
Where is there distress at a time of 4% high-yield bond yields?
Well, we still have businesses that, if you look through, that we had a very high default rate in 2020, and we continue to see an above average default rate coming in. And don't forget that last year we had default rates at almost 7% in bonds and in excess of 4% in loans and lower recoveries. We obviously had some gyms who survived, as an example, or we had restaurants and quick serve restaurants all suffered and many defaulted. So as a result, the areas that really had the 95% declines in revenue, which was the leisure, travel, and entertainment categories, certainly experienced defaults. The companies with access to capital will be the ones that, similar to your earlier comments on the show, talked about Americans who've gained the COVID-19 pounds. We have many companies that have a much larger balance sheet with the amount of debt and equity. And will the new cash flow that plays out in 2021 be adequate to service that valuation or that level of debt? I think there will be many who won't. And as a result, that's what we think the new defaults will be, that growth as it changes. I saw the announcement today that the streaming window for theaters has been shrinking. That's only going to affect the ability for theaters to generate cash flow. And as a result, an area that we think that debt probably is solvent, but equities are probably too highly valued.
Don, good to catch up, sir. Don Mullen, Prodium CEO and founder. Don, thank you. Just want to turn back to something important. Michael McKee really helping to frame a conversation. I do think framing a conversation appropriately is important here. Pro tip, remember in reading the breakdown of the Biden Build Back Better plan, that the administration is talking about spending $3 trillion over 10 years. A lot of money, but not the same as shoveling $1.9 trillion out of the door in 21-22. Lisa, I just thought that was a really good point that Mike McKee is making out on Twitter this morning.
I agree. I also think it's important to know that not all of the American Act that was passed, the $1.9 trillion plan, most of it has not been spent yet. And that actually would be one key question to Janet Yellen today in Congress, this question of how much has actually been deployed, how much more has to get back into the economy. And that will also give people a sense of how much more of a boom there will be as this filters into state and local governments, as this filters into plans for healthcare and beyond. And John, to me, that affects growth so much, and the uncertainty and the pause that you're feeling in today's market.
Yep, the House Financial Service Committee holding that hearing with the Fed Chair Jay Powell and Treasury Secretary Janet Yellen. That will take place at midday Washington, D.C. time, so midday Eastern time, a little bit later on this afternoon. Coming up on this program, Megan Green, Harvard Kennedy School Senior Fellow on policy down in Washington and policy down in D.C., not just on the fiscal side. President Kaplan of the Dallas Fed really making some waves going into this hearing. He sees a hike in 2022. That's his view, not the median dot on the committee. He sees the 10-year Treasury yield rising further to 175 to 2. That's what we want from the Fed, isn't it? A price target on the 10-year Treasury. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. I'll keep it short and snappy. Here's the price action. Outperformance on the NASDAQ, underperformance on the Russell, the S&P 500 down about 1/3%. Just a bit softer, defensive. You see that in the bond market too. We'll get to that in just a moment. It is 1 year on from this mess. Switch up the board. Over the last year, the S&P 500, what a move it's been over the year. What are we up? 76% on the S&P 500. Just amazing just to see that, isn't it? 39.40 right now on the S&P 500 at the close yesterday. But the leadership's changed. It's not about just growth and big tech. It's not just about the NASDAQ anymore. It's about the financials. It's about the energy story. I can tell you the crude story's breaking down a little bit today. But the financial story's been held up by what's happened in the bond market. So let's finish on the bond market. 2s, 10s and 30s on treasuries. Yields are down 5 basis points on a 10-year. On a 30-year, your yield right now, 236. And on a 10-year, we have a forecast from the Dallas Fed president that I know Michael McKee is itching to talk about. He thinks that this 10-year...
Well, ladies and gentlemen, it's look like I will have to cancel order to buy Bitcoin because it takes too long, almost an hour, to execute, and it moved up rapidly. So for time being, please cancel your order to buy Bitcoin, and I will let you know when, if you're looking to trade Bitcoin, when the right time will come. Otherwise, it's not much point to hold forever. It's better to invest in other pairs or other securities. Okay, so the order to buy Bitcoin, cancelled.
Voice.
Well, I think probably Rob Kaplan forgot the old saw about you make a forecast about a number or you make a forecast about a time period, but you don't combine the two. I don't think Jay Powell's going to be too worried about it. Powell and Janet Yellen are going to be up on Capitol Hill today talking about how the year has progressed. And you look at their opening statements, and there's not much in there. And Powell has said if the economy is getting better, we would expect rates to rise. And you look at 175. What's magic about that? I mean, it's about where we were a year ago coming in, or well, more than a year ago now, coming into 2020. So it isn't going to bother the Fed too much that rates are rising towards that level, especially given the speed with which they are rising relatively slowly. Yeah, go ahead.
But Mike, I would argue it's not the long end that people are really thinking about. I mean, his projection to 2% Treasury yields sounds like a lot given where we were last year, but it's not that much relative to history. But the idea of raising rates in 2022 is something that flies in the face of all of the messaging of the Federal Reserve, and frankly, it edifies some percolating concerns in the market that the Fed will not be able to avoid hiking rates if inflation stays hotter than some people expect. How much will Fed Chair Jay Powell have to address that? The concern that if inflation does overshoot, even if it's in the near term, they're going to have to respond.
Well, he's going to say that if inflation does rise significantly and quickly and gets to their 2.5% perhaps upper bound, the Fed might act, although they do want to see it stay there for a while. So it's really going to be about the speed and the orderliness of any inflation rise. They're predicting we get 2.4% this year. So if we do get to that, the Fed is not going to be worried. But obviously, it'll be a political topic up on Capitol Hill. Yellen and Powell are going to talk about how things have really improved. The forecasts have really improved. In her prepared testimony, Yellen says we'll get back to full employment by next year. So they're going to be relatively happy with the outlook for now. And if Rob Kaplan were to be right, I don't think either one would complain.
Mike, you asked the most important question on the news conference that didn't get answered by the chairman, and we've gone back and forth about this. And I think you need to talk to Mike Collins over at PGIM, because he's thinking about the same dynamic that you are, that if the Fed isn't going to hike with the numbers that they're forecasting right now, if this guidance is anything to go by, when will they? And do they miss the window? And do they go through the whole cycle with just never raising interest rates? And Mike Collins at PGIM answered that question for you, Mike. He thinks there's a better chance of that happening than not right now, at least relative to what everyone else is saying. What's your take on that, Mike, and the conversation you're having with other people about it?
Well, that's the problem with the Fed's forecasting devices and the dot plot and as such. And Rob Kaplan saying today he's a 2022 dot. You really don't know that far down the line how the economy is going to develop. The Fed, based on the forecasts it's making right now, would not raise rates until 2024 and beyond, because they don't see inflation getting to their target and staying there. But that's not realistic. And so there will be questions as we go along, and perhaps as we get into 2022, about whether the Fed will miss a window or not. Remember how important it was for the Fed to raise rates back in 2015, 16, 18, when they were talking about you need to be able to cut rates, you need to have some room to cut rates if you have a recession, that sort of thing. We'll see those questions come back, and we'll see how long the Fed wants to hold out.
Mike, great to see you, sir. Always the best question in the news conference, and now progressively getting pushed further and further to the back of the line in the news conference. Mike McKee, thank you. We're bringing that hearing live today at 12 p.m. Eastern. Don't miss it. Chair Powell, Secretary Yellen. I've almost said Chair Yellen so many times this morning. Lisa, I've had to slow down every time I've said it. Secretary Yellen, Chair Powell, 12 p.m. Eastern, a little bit later. Let's bring in Megan Green, shall we? Harvard Kennedy School Senior Fellow. Megan, do you think it's too premature to have that cycle conversation, a conversation about the cycle and maybe this Fed just never raising interest rates?
I think it is a little premature. There is a huge debate raging about, what kind of inflation we're going to get. We know we'll get some temporarily. The Fed has acknowledged as much. But will it be sustained? That's a big question. I do think, though, at the end of this year, if we have unemployment at 4.5%, as the Fed expects, and as Secretary Yellen says, we should get to full employment next year. And if we have inflation at 2.5% at the end of this year, which isn't impossible, it is going to become increasingly untenable for the Fed to argue that the appropriate policy rate in those conditions is zero. So I actually think that the Fed will be pushed into hiking sooner rather than later. So I think the scenario where the Fed just never hikes through this cycle is a pretty unlikely one.
Can we put a number on sooner? Are you a Kaplan 2022 type of call if you're on the FOMC right now, Megan?
If you force me to, the Fed has said that they're going to go ahead and taper purchases first, and that they'll provide a long runway for investors to do that. If we ended up having the Fed hiking in 2022, it would probably happen in the latter part of that year. But I think that's certainly possible. And certainly I think it's likely before the Fed's own forecast, according to the dot plots, which isn't until 2024 at the earliest.
And that implies also that they will start to taper the $120 billion of bond purchases that they've been making monthly. How soon could we see tapering?
So you could see them start to discuss it at the end of this year. Look, I think tapering is going to be really tricky. Even if the Fed goes ahead and guideposts this very clearly well in advance, it represents a binary shift. And therefore, I don't see the Fed being able to taper without roiling the markets. And we know what happened last time we had a taper. There was a tantrum, especially through emerging markets. And I think this is something that investors really need to watch.
How does financial stability weigh in on this? The idea that the markets are supported by the Fed's ultra-easy policies at a time when we do have a new boom supposedly underway?
Well, that's certainly, one of the reaction functions of the Fed, even though it's not part of their official mandate, it is indirectly. And so the Fed is looking at this, but even if you get rates starting to go up very gradually over the next couple of years, it's from zero. And so while a bunch of the markets could look frothy, there might be room for the Fed to start to normalize rates. I don't think we'll ever fully normalize rates, but at least start to hike them. So, it's a consideration, but I think that that's a balance that the Fed's going to have to get, and they had to get it right in the last hiking cycle as well.
Megan, looking forward, do you think that's what's shaping the views of the likes of President Kaplan on financial stability and rates? Do you think he's tying the two things together?
Yeah, look, Kaplan's a markets guy, so I think he's absolutely tying the two things together. But, I think it's not just financial stability, it's also the robust growth forecast that we have, as well the bond market moves that we've seen so far this year. I think it's all of it together, but he's certainly looking at the markets and thinking that some of them are frothy. He's come out and said that before. So that I'm sure that's a part of his reaction.
He's said that repeatedly on this program. I just wonder how lonely he is on that FOMC right now. Megan, it's good to catch up. It's good to see you, as always. Harvard Kennedy School senior scholar. Just want to bring you some headlines from Dr. Fauci on AstraZeneca. This is an unforced error. This is very likely a very good vaccine. Not quite the full endorsement you'd want at this point for a company that's really suffered some PR issues over the last couple of months. And Lisa, those PR issues right now not going anywhere anytime soon.
Unforced error. At the same time, how much is he a participant in it? You raised this question. He read this data where there are flags on it. Why are they continually making unforced errors at a time of such crucial health importance, John?
Luckily in America, it is not a big issue as compared to the issue with AstraZeneca in Europe, because luckily in America, the reliance is not on AstraZeneca, it's on Pfizer and Moderna, and increasingly in the coming months will be on J&J as well. And we're looking at numbers now of 127 million doses given in America at a rate of 2.49 million. Lisa, luckily in America, the emphasis for this rollout has been with other companies, away from AstraZeneca.
Yeah. And I want to pair this, the numbers that you keep repeating, and rightly so, about the vaccinations and how they're ramping up in the United States with this idea of froth in markets. And I think perhaps the people who are concerned about financial stability are looking at the fact that there's more of a rational behavior underpinning some of the market moves. That, as you've talked about, John, there's a shift from the growth stocks, the big tech names, to the cyclicals, and that's continued, and that's where the outperformance is coming. Perhaps it's giving them some faith that there's something behind these moves beyond just faith that they're going to hold rates low forever. So, yes, we are seeing that improvement, but yes, we're also seeing a very rational investing behavior in markets.
Let's run through the tape for the audience just quickly, Lisa, and get everyone up to speed. Bit defensive this morning. Lisa talking about the themes on the way forward. Bit defensive on the morning this Tuesday, coming about 12 points on the S&P 500, positive about 0.1% on the NASDAQ. Outside of that, there is a bit into the bond market, though. We're off the lows of the session, 165 on 10s, 236 on 30s. And in foreign exchange, euro dollar, where are we now? 118.90, coming 1/3%. The news in Europe, not great. The news in America, better. The spread between the two, arguably wider over the last 3 months. How have you pushed that through foreign exchange? Well, we've had a move from 123 to 118. What's left? It's the what's left I'm intrigued by, with the incremental bad news out of Europe not doing much to this currency pair over the last several weeks. Coming up on that conversation, we'll touch base with Jean Bavin, the BlackRock Investment Institute head. Looking forward to that. And Lisa will drive you forward into the 9 o'clock hour. I'll be on Bloomberg TV, counting you down to the open. From New York City, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. In Boulder, Colorado, police aren't saying much about the mass killing inside a supermarket. A gunman killed 10 people, including the first police officer to arrive. A suspect has been arrested, but police haven't released his name yet or discussed a possible motive. Treasury Secretary Janet Yellen and Fed Reserve Chair Jerome Powell will get a sense of how concerned Congress is about inflation and the deficit. They'll begin 2 days of congressional hearings today. Republicans blasted the pandemic relief bill as excessive. Now President Biden is on the verge of proposing a more expensive bill to fix the infrastructure. And growing numbers of Mexicans are heading north across the border. They're being spurred on by an economic crash at home and promises of a stimulus-fueled resurgence in the U.S. Since the middle of last year, the number of monthly apprehensions of working-age Mexicans traveling without children has more than doubled to around 40,000. At a yearly rate, that would be the most in a decade. And the UK and the European Union are trying to break their deadlock over AstraZeneca's coronavirus vaccine. EU negotiators want to avoid an escalation that could see exports to the UK blocked from the drug maker's plant in the Netherlands. They proposed the two sides share its output.
Accusations of vaccine nationalism are so wrong in terms of Europe because we are very international in our approach. We're exporting. I think we should maintain that, but have good conversations with other stakeholders about maybe what they might do to reciprocate.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We're going to have a very boomy economy for a while, then it's going to settle back into normal, and that trajectory does not look unreasonable. So if growth is peaking, everything's peaking now, inflation is peaking in the next 12 months, why should interest rates go a whole lot higher?
That was Michael Kushma, Chief Investment Officer of Morgan Stanley, a global fixed income, really raising the question about how you price in inflation at a time when it's expected to boom and expected to increase way past the trend and then come right back down as we have not exited secular stagnation, according to a lot of people. Joining us now, I'm so glad to have Barry Ritholtz on this morning, because right now I want to get an understanding of whether we have too much optimism or too much pessimism. And frankly, that pendulum has been swinging around at record speeds. Barry Ritholtz joins us now. He is the Bloomberg podcast host of Masters in Business, also the founder of Ritholtz Wealth Management. Barry, always wonderful to speak with you. I want to start with that. Have you felt this huge shift from pessimism to optimism, and now perhaps people are wondering whether that optimism has gone a little too far?
I think we have to be careful about painting with too broad a brush when we talk about sentiment. I can't ever recall in history where market bubbles were called so fervently and frequently in real time by participants, but we've been hearing people say this is a bubble now since, I don't know, is it 5 years? Certainly off the lows last year, the bubble drumbeat started. It's kind of hard to see markets, you know, being overly optimistic when there's so much fear on valuation and bubbles. I know it's very counterintuitive, but it's just not what you typically see when everybody just throws caution to the wind and they're all in.
Sure. Well, but Barry, we're not necessarily going to be talking about a bubble here as much as the hope in the recovery, the cyclical trade, the move away from growth, the idea that you can pile into airlines, the idea that you can pile into cruise liners that have tons of debt that haven't yet started to float their boats around the world. And I wonder whether you are starting to get the sense that the optimism has been priced in and that there isn't that much upside in this cyclical trade, or whether you kind of get the feeling that perhaps people are just taking a pause here as they assess the landscape going forward, but that will regain steam?
Well, try not to put it in binary terms of are people too optimistic or too pessimistic about the recovery. Markets make probabilistic bets. How strong is the recovery going to be? Will it be 2%, 4%, 6%? We've seen some people float numbers 6.5%, 7%. So if the upper range of the economic recovery is right, well, then there's a ton more revenue and profits for corporate America, and stocks aren't overvalued. On the other hand, if we're overemphasizing, if we think we're going to get back to normal, if the estimates are way too early, way too fast, well, then markets are clearly pricey here. We don't know what the next 12 to 24 months of the economy are going to look like. And what you're seeing in this bull-bear debate is really an argument as to how fast are we going to get back to normal? How quickly will that fall to the bottom line of companies?
What are you doing with your money right now, Barry?
The same thing I always do. I look out 10 to 20 years. I don't care about Tuesday because, you know, or what happens this week or this month. Humans are terrible at conceptualizing long periods of time. We're really bad at it because we exist in the here and now. And you know, most of evolutionary history, life was short and brutish. So no one really thought much about retiring 20 or 30 years hence. So we try and look out a decade or two. We have clients that have perpetual time horizons because they're investing either for philanthropy or foundation or for their grandkids. And so any given day or week, people hate when I say this, but it's irrelevant. The fact that markets fell 22% in October 87, look at it on a chart. It's a little squiggle. If you were retiring 20 years hence, what did it matter? It's almost irrelevant. So I know we're all in the news business and we want to keep up with the day-to-day goings on, but you know, it's hard to be long-term bearish on where the United States is. I'm thrilled with how fast the economy is recovering. I wish people were a little more circumspect and continued to wear masks and not go crazy on spring break. That can slow the recovery down. But the market has correctly sussed out how quickly the vaccines would be available, how fast we would get over the valley of, you know, zero profits. And the market is telling us this economy is going to ramp up pretty quickly.
Barry Ritholtz, thank you so much for being with us. As always, Barry Ritholtz is a Bloomberg opinion columnist, founder of Ritholtz Wealth Management, and of course the host of Masters in Business, a Bloomberg podcast that I highly recommend. And talking about being in the news business and following the day-to-day, the big question in the day today is going to be the fiscal deficit and how we are going to pay for it as the United States borrows more and more money in order to get the economy back on its track. And Michael McKee, Bloomberg economics editor, still with us. Mike, I'm wondering from your perspective what the message will be from Janet Yellen as to when the debt becomes too much for the economies to sustain.
I'm sure she won't put a date on that. She'll say, in theory, there is a time period when that could be an issue, and it is an imperative that the U.S. do something to bring down its debt. But the time is not now. She's not going to get caught out in a game of putting dates on it. But it's going to be important because what she says, because they are introducing sometime soon the new Build Back Better plan, which the various news organizations are reporting at $3 trillion over 10 years. And that's going to raise questions about additional spending that she will certainly get asked about.
And what about Jay Powell? How will he weigh in terms of capping yields at a certain place, buying more debt if yields rise too much to support the national fiscal deficit?
Well, I think he will also dodge. His statement has usually been something along the lines of, we will use whatever tools we need to keep the economy expanding. And I think that's what you'll see him say today.
All right. Anything else you're expecting to hear from the conference? If you were there, what would you ask?
Well, I think the inflation questions and how fast it will come back, that sort of thing are going to be paramount. But he may also get asked about the supplementary leverage ratio. That may be more of an issue tomorrow before the Senate with Elizabeth Warren and Sherrod Brown. But the whole idea of, are you giving a break to the banks, is something that is going to be a political issue up on Capitol Hill.
Michael McKee, a Bloomberg economics editor, thank you so much for being with us. We will be watching that House hearing today at noon. Janet Yellen and Jerome Powell taking the hot seat before a House committee. Right now in markets, we started the day saying that we saw Treasury yields going lower and the NASDAQ also going lower. That has reversed. The NASDAQ up 37 points. Meanwhile, you've got the S&P down 10 points, really range bound as people try to gauge the lockdown that's expected in Germany with the ongoing economic enthusiasm in the United States, as well as potentially a $3 trillion infrastructure spending plan from the United States. I'm Lisa Abramowitz, Jonathan Farrow, Tom Keene back next Monday, and this is Bloomberg Surveillance.
can somebody remember things that happened 80 years ago? How do you do that?
David, it's easier to remember 80 years ago than what I had for lunch today.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Testimony on Capitol Hill from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. 30 minutes away from that opening bow with equity futures down 9. We're negative 0.25%. We begin with the big issue, the push and support for an unprecedented spending spree.
These numbers are big. $3 trillion.
Another $3 trillion.
You're coming off a huge influx of fiscal support.
This, nearly $1.9 trillion package. The $900 billion that was passed in December.
Over a period of 2020 to 2024.
Trillions and trillions of dollars worth of debt.
We're talking $8.5 trillion.
This is simply a U.S. government that has lost their fear of debt.
Such a big shift in the focus of fiscal policy.
Driving the U.S. economy by a boom in GDP.
And the focus of monetary policy.
They want to grow their way out of this problem.
We care about what the Fed is going to do. We care about what Washington is going to do.
Chair Powell, Secretary Yellen, 3 hours away down in D.C. Let's bring in the Bloomberg team. Michael McKee and Kelly Lyons. Morning, Mike.
Good morning, John. First thing I want to do is wish you a happy anniversary. It was 1 year ago today that the Fed announced it was going to do QE, whatever number we're on, basically unlimited bond buying and buy corporate bonds. The stock market opened that day at its pandemic low, and it hasn't looked back since. You can see the headlines from a year ago. But looking back today is a little bit about what Chairman Powell and Janet Yellen are going to do as they testify before the House Financial Services Committee. And after $5 trillion in additional fiscal stimulus and all those Fed actions, they're going to sound a little bit more optimistic. They released their text last night. The recovery has progressed more quickly than generally expected, Powell is going to say, and looks to be strengthening. This is due in significant part to the unprecedented fiscal and monetary policy actions I mentioned, which provided essential support to households, businesses, and communities. For her part, Janet Yellen says, with the passage of the rescue plan, I'm confident that people will reach the other side of this pandemic with the foundations of their lives intact, and I believe they will be met there by a growing economy. In fact, I think we may see a return to full employment next year. Getting an early start on not moving the markets today, because these are things they've said before. They go on to promise that they will keep on top of this and keep working to keep the economy growing. It doesn't mean they can't or won't be asked about controversial topics, however. Powell certainly will be asked about inflation and maybe the comments from Larry Summers that this could be the worst economic policy in 40 years. He'll also probably be asked about the supplementary leverage ratio and whether or not they're giving a break or not to banks. And as for Yellen, all the major papers, I'm sure you've seen, John, have breakdowns of the $3 trillion over 10-year package that they're expecting from the Biden administration in their Build Back Better plan. And she will no doubt be asked about that. It is not just an economic issue. It's going to be a very political issue up on Capitol Hill.
Mike, it's important to sit on this moment. This is such an important moment. Someone is going to look really, really stupid because they're either going to be wrong or they're going to be right. And it's either going to be Larry Summers or the people making these decisions.
Yeah, these are high stakes, put it that way. Now, Larry has 3 different possibilities, 30% for each, so he probably will find a way to be able to say
he's still an
right
economist,
about
Mike.
something.
Still an economist.
But I think the point about what Larry Summers has done is he's raised questions that deserve discussion and answering. And if he forces the administration into that, it's probably a good thing.
Got to talk about that a little bit later, and these comments from Dallas Fed President Robert Kaplan across the wires in the last 30 minutes or so, advocating for a hike in 2022 if the forecasts materialize in the way, the fashion he anticipates. And then getting a yield call from him too, that he sees the 10-year Treasury yield rising to 1.75 to 2%. We saw 1.75 last week. For more on the bond market and more, is Katie Lyons.
Well, John, of course, what Larry Summers is concerned about is the sheer amount of spending that already had been pumped into the economy before even the $1.9 trillion in aid that we just saw start filtering its way through, and what that is going to do. Already, that crisis response, which has been unprecedented, has pushed the U.S. budget deficit to 16% of GDP. That is well above the collective deficit increase that we saw in the recessions in the 70s, in 1982, in 2000 and 2008 combined. So this is where that worry about not only the deficit, but about inflation comes from. And we have seen that reflected across asset classes this year. It's shown up in the commodity complex with industrial metals up about 9.5% on a year-to-date basis. But of course, John, as you were just alluding to, it has shown up most notably in the bond market. In the less than 3 months since the start of 2021, the 10-year yield is higher by 74 basis points, and that's even after we're off last week's highs. The 10-year back around 1.65% this morning. And of course, it's not just in the longer end of the curve, but the belly as well, with the 5-year yield up by 47 basis points. Granted, the bulk of those moves have been coming from higher real yields, John, but higher break-even rates are a factor as well. And when you look at the 5-year break-even, it's hovering right around 2.5% right now. That, of course, is how the market is pricing inflation expectations over the next 5 years. But when you look at the forecast from the Philly Fed survey of professional economists, it is about 50 basis points below that, just around 2%. Yes, it has picked up, but not to the same degree. And of course, the argument that the Fed and Jay Powell have reiterated time and again is that inflation is going to be transitory. They will look through it. The market, though, not necessarily on the same page, John.
Kelly, thank you. What a moment down in Washington to have all this supply, all this fiscal effort, this impulse from Washington, and a Federal Reserve just willing to sit there and look through it if the chairman's guidance is anything to go by. On that debate, Jean Bavin of BlackRock Investment Institute weighing in on the inflation debate and running the following. Even though unprecedented amounts of fiscal spending have already been deployed over the last year, we see more fiscal spending being lined up, and at least so far have not seen any adverse consequences. Jean, let's start right there. Why the view of you and the team at BlackRock is still that we have not priced in all of this, that still we are underestimating the degree of snapback, the boom that we could get in this economy. How so?
Yes, good morning, John. Thanks for having me. I mean, there's a couple of reasons where we still believe that the restart dynamic, and we use the word restart deliberately, is underappreciated. The first is the nature of the shock itself is not a usual business cycle, right? So we've been arguing that we need to throw away the business cycle playbook, and the restart dynamic is really about turning things back on, and that's going to surprise compared to what we've been used to see historically. You know, the Fed is now penciling in a 6.5% growth for this year as a whole year on year. You know, in 2010, 2011, after the global financial crisis, we were in a world of 2.5, 1.6%. So this is much more powerful. And I think the Fed is actually just starting to embrace what the restart is about. I mean, the consensus is higher than that. We're more around 8%. So we're talking big numbers. And I think this is part of it. The second part, if I may, sure, is simply that, you know, we're having this massive fiscal stimulus now coming through, and the shock is of a different nature. You know, a lot of this activity is restarting on its own once the pandemic is under control, doesn't necessarily require a stimulus. And so I think that you add that to these numbers we're already penciling in, plus a massive fiscal stimulus coming in the context where restart will happen, probably even without a lot of that stimulus, that creates, I think, a lot of potential for upside surprise on the restart.
Jean, I want to pick up on where you started and where you finished with the words restart. That word restart, this is a restart. It's not a traditional recovery. Jean, it makes me wonder, when we get to the end of the year, where in the cycle we'll actually be. If this is not a typical cycle, it's just about turning the lights back on again, where do we wake up at the end of the year? Where are we in this cycle?
Yeah, so I think this is a great question, because I mean, it's not like the pandemic has solved by itself the challenge that we were facing before we would get hit by that shock in February 2020, right? So we were facing a world where the debate was about secular stagnation, like risk of like low inflation. I mean, the pandemic hasn't magically solved that. So I think there's an uncertainty and different scenario you can contemplate. But I think one that we need to contemplate is restart is going to look very powerful, but we're restarting to where we left it, which was a world where, the questions were about late cycle dynamics, a lot of being reflected in valuations, and growth prospect being, moderate.
So let me put you on the spot here, John, just to jump in if I may. Are you anticipating what comes after this initial reopening boom is just a return to what we saw before? And if so, what is the biggest investment implication of that?
Yeah, so I think we were expecting to as a baseline, we're expecting to go back to kind of trend growth. We were on a path before the COVID. It's not a replay of 2008 where we got the crisis and then that opened the door to a decade-long bull market. I think this one will be different, much more powerful, visible in the near term. That has been supporting asset price very materially, but I wouldn't extrapolate performance over the next 10 years. So I think we have moderate, risk expectations over the next 5 years. And what it means at the end of the day for us, it's a massive policy revolution that is questioning the role of bonds in portfolio, government bonds. So we're underweight government bonds on a strategic basis. We think that there's going to be more duration risk that's going to be perceived by investors, and that's going to make the asset class less attractive. And on a relative basis, risk asset will continue to be supported by, a moderate growth beyond the very fast restart. So overweight to global equities and underweight strategically on bonds.
John, this is an important conversation. I'd like to bring in another voice in just a moment, so stay close if you can. Let's turn back to the markets just quickly. The bond market's bid, the equity market a bit softer through the morning. Let's get to the market desk and get you some movers. It's Taylor Riggs.
Indeed, John, looking at some of the losers to start here. AstraZeneca, I continue to be confused about some of the press releases and the updates that we will get from a company in 48 hours. But of course, this time around, hearing that the data on that U.S. trial really was a month old. So waiting for updates from that company. We take a look at Viacom CBS as well. This is the stock. It's up 600% in the last year. So, well, rightfully so. They sell $3 billion of shares to help fund the streaming rollout. Amazon as well looking to sell part of their Deliveroo stake, which would cut their stake down to about 11.5%, give them $150 million. Microsoft as well, it's merger Monday, it's merger Tuesday, spending about $10 billion to buy Discord, John. So lots of movers today.
Looking forward to more coverage from you, Taylor, through the hour. Taylor Riggs, thank you. Coming up, the Biden administration beginning the push for its next multi-trillion-dollar spending bill. That conversation up next with BlackRock's Jean Barvan and Tolbacken's Michael Purvis from New York City this morning. Good morning. 20 minutes away from the opening bell. Equity futures just a bit softer through much of this morning. This is Bloomberg. It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We're hearing the next few months might bring a so-called infrastructure proposal that may actually be a Trojan horse for massive tax hikes and other job-killing left-wing policies.
Partisan divisions already emerging as the Biden administration prepares to roll out its new multi-trillion-dollar spending package. The White House press secretary, Jen Psaki, saying it's too soon to discuss the details. She tweeted the following: "The president is considering a range of options, scopes and sizes of plans, and will discuss with his policy team in the days ahead. But speculation is premature, given he does not plan to lay out additional details this week." Let's bring back in the panel, shall we? BlackRock's Jean Barvan is joined alongside Torbacken's Michael Purvis. Michael, I want to start on fiscal and start here. How durable do you think this fresh fiscal impulse is? Is it something that lives with us through the next several years, or just a story for 21?
Well, I think the answer to that question really resides in large part in the midterms, right? There is a strong fiscal impulse. I think there's a lot of sort of political resonance with Biden in terms of, if you will, making the U.S. Sort of the new China, if you will, for this particular cycle. If you scroll back 10 years, China was the one that was sort of underscoring the fiscal impulse. The U.S. was relatively light. After the trillions of dollars we've just done, and if we do this this new $3 trillion package, it does sort of position U.S. GDP in a much durable, much stronger way. I think, but the question is you have to keep remembering that the control that the Democrats have in the House and the Senate is really razor thin right now. So if the Democrats are going to retain retain control after 22, then I think you could probably look at a much more durable condition there. If they don't, then it's a different picture.
Mike, I think you touched on something really, really important, though, that I don't just want to let slide by. I think we've got to sit on it just for a moment, John. It was the moment there where we talked about China previously leading the cycle coming out of the last crisis, and now we're talking about the United States. Now, if the incremental GDP growth is coming from a US boom and not from China, what are the investment implications of that, John, relative to what we saw coming out of the last crisis, which was just commodities ripping into a fresh super cycle?
So I think the two numbers I would put on the table, 1 quarter and 4 times. 1 quarter is, in our estimate, the size of the shock we're facing right now globally compared to what the global financial crisis was. So it's a fraction of the cumulative impact of 2008 in our view. And then 4 times is the in the global financial crisis. So I think this is a bit of the China playbook being applied now in this cycle. I mean, it turns out that China is also leading the cycle as well, this one as well, but not from the fiscal impulse dynamic. And I think the big fiscal implication for market for us is around what it means for what we call the new nominal, which is the fact we get this big fiscal impulse, but in a context where we think ultimately central banks will have to play a big role in maintaining low rates for some times. And that combination, I think, is going to be for some time pretty constructive for risk assets, at least for like this year and going into next year.
This year into next year, when you say risk assets, John, what do you want to own?
So so global equities as a general call, but I think in more granularly U.S. Given the impulse we're talking about, I think it's going to perform well and outperform. But we also think that the emerging market side of things, being ahead of the curve, and China, the China pull of growth, is also favored in this restart. The cycle is broadening as well. So I mean, Europe cyclically was a bit more challenged, is lagging behind, but we think now will be a bit more constructive. So that turns out to for us to be a more neutral stance.
Interesting.
But that's the places where we would see the.
We'll continue that conversation around Europe in just a moment. John, I want to take the opportunity to say thank you because I know you've got to run. John Bovan there of BlackRock. Michael Purvis, you'll be sticking with us. I want to head down to DC to catch up with our chief Washington correspondent, Kevin Cirilli, to see how this story is developing down in DC. Kevin, what is the latest? I've heard the number, $3 trillion. We've all heard the number. What's the plan?
Well, two things. First and foremost, how are they going to pay for it? Democrats are being pressed, and they're not united in terms of how they're going to pay for an infrastructure plan, John, especially when it comes to whether or not to raise taxes. Over the past couple of weeks, we've had this tax discourse increase in the political conversations here in Washington, D.C., whether it be Senator Elizabeth Warren or whether it be even Treasury Secretary Janet Yellen. But what we don't know is whether or not that increasing taxes on billionaires, on ultramillionaires, or even income earners who earn more than $400,000 annually, whether that will attract bipartisan and centrist Democratic support. But secondly here, Republicans are very skeptical of this. The window of opportunity to pass a massive $3 trillion infrastructure proposal closes as we get closer to a midterm election cycle. If you follow through the timeline here, the earliest that this massive plan could get through is midsummer, and that's an early bet. And so the timeline here becomes increasingly important, especially as Republicans, again, are very skeptical of spending another round of economic stimulus.
Kevin, we have to turn to something delicate in just a moment. I wonder whether the administration has responded to the tragic shootings that we've seen more recently. What has the response been?
They have. White House Press Secretary Jen Psaki has said that President Joe Biden is carefully monitoring that situation. What I'm looking for today is whether or not this reignites a gun safety debate in the halls of Congress, and if it does, that could have severe implications to another issue that moves beyond that, which is the filibuster, and whether or not there's going to be pressure to break the filibuster as a result to get some type of gun reform laws changed. That's where Senator Joe Manchin, John, who backed a bipartisan bill on gun control with Senator Pat Toomey, a conservative from Pennsylvania. That's where it's going to get very interesting very fast.
Kevin, thank you. We can turn now to the New York Stock Exchange and the NASDAQ for a moment of silence for the shootings in Atlanta, Georgia and Boulder, Colorado. Here's some of the price action for you going into the opening bell in New York City. Equity futures down around about 9 points on the S&P 500, down 0.2%. Let's get you some morning calls to look at some of the analyst recommendations on Wall Street this morning. First up, Berenberg downgrading Burlington Stores to a hold with a 314 price target. The analyst no longer seeing a favourable risk-reward profile following the stock's 60% rally. Run change there going into the opening bell. Your second call from Longbow upgrading Texas Instruments to a buy, a 220 price target. The analyst highlighting the stock's attractive valuation with channel checks pointing to healthy demand. And your final call comes from Argus upgrading Netflix to a buy, a 650 price target. The analyst seeing sustainable competitive advantages stemming from its expanding user base and popular original content. That stock is up by a little more than 1%. Let's sit there just for a moment and bring back in Michael Purvis of Tallback. On big tech, Michael, under the radar, we really stalled out in late August, early September. Do we need the yield story to develop in a different direction, or can we consolidate differently? Does it have to be about the bond market?
Well, I think, you've clearly seen a rising correlation of tech shares with the rise in yields, right? So there's always some sensitivity, but it's been really pronounced with this big jump in yields. In my view on that is really it's a function of the relative equity risk premiums on big tech versus the broader markets. It's just simply much thinner and therefore much more vulnerable there. But that equity risk premium issue will be restored by a reaffirmation that earnings growth is strong right now. So, the short answer to your question, John, is that I would expect, continued rate sensitivity here. But again, if you were going to go invest into large tech right now, there's nothing fundamentally damaged by the fact that the economy is really good and that rates are rising for Microsoft or for Google, right?
Yeah.
It's really, this whole discussion is really more about relative greed than it is about, fear, if you will, there. So, whether something is a little bit more overpriced relative to a higher interest rate environment.
Well, certainly it's a rate story this morning. Outperformance on the NASDAQ, underperformance on the Russell, and a bit into the bond market. We spent the last couple of days talking about whether this is just correlation or some causation there, a reinforced narrative just because we've been conditioned by the price action over the last couple of months. Mike, stick with us. Coming up on the program, it is the countdown to the open. It is a one-year anniversary of the market's bottom 12 months ago. Tallback's Michael Purvis and Invesco's Brian Levitt discussing the top performers since the pandemic lows. From New York City, counting you down to the opening bell, equity futures up 40 on the NASDAQ. We're down 9 on the S&P 500, just a little bit softer as we count you down, not just to the cash open, but to the big event down in D.C. in about 2 hours and 30 minutes time, where Chair Powell and Secretary Yellen testify to the House Financial Services Committee. This is Bloomberg.
Everybody says we should practice before we go to Mars, but some people say we need to practice on the moon. Well, you could practice on the moon, but you can do it at 1/10,000th the cost in the desert in Utah.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. 25 seconds away from the opening bell. It's all about one thing this morning. It is about the countdown to testimony on Capitol Hill from Chairman Powell and Secretary Yellen. Going into that, equities a bit softer on the S&P 500, down 0.2%, negative 8 points on the S&P, and a performance on the Russell. We're down 0.9 there. Outperformance on the Nasdaq, we're up a third of 1% there. There's the opening bell in New York. Switch up the board into the bond market. Treasuries look like this. Yields are lower by 4 basis points to 165.23 on 10s. In the FX market, the euro is weaker. The dollar's firmer. Euro dollar 118.75. Got to talk about the spread between Europe and the United States a little bit later on in the program. And in the commodity market, softer, lower. We head south on WTI, 58 handle to 58.95 and down a little more than 4 percentage points. That's the cross-asset setup this Tuesday at a market desk with your movers. Let's welcome back in Kriti Gupta.
You just mentioned that step back lower for oil. WTI testing that 59 handle and its 50-day moving average, and that's having a read-through into the stock picture, especially when some of those oil majors, things like Chevron, ConocoPhillips, all taking a step back today, once again in line with that oil move. And with lower oils, you're also seeing lower yields, and of course, that's dragging the financials along with it. Just take a look, JP Morgan, Bank of America, also down on the day. I also want to take a look at AstraZeneca as well. We have to talk about it. The vaccine maker set to redo its trial results. Dr. Fauci coming out and saying there are some concerns about the optimism in that press relief. And I also want to take a look at those media companies. Let's just start with Viacom here, set to sell $3 billion in stock to help fund the build out of its streaming service. Discovery downgraded at UBS. The analysts saying streaming gains are built in. And lastly, AMC extending a 10% drop after yesterday's recent run-up. Remember, John, we have those GameStop earnings after the bell today that could have an impact on AMC shares.
Kriti, thank you. I was talking about this earlier. It will be so refreshing to actually have a conversation about the company, about the fundamentals, about the corporate strategy, and not just the speculation that's dominated the conversation over the last couple of months. That's GameStop. That's the story for later. Story right now, about 1 minute and 40 seconds into the session, we pulled back on the S&P 500 by 0.2. Energy bottom of the pile, no surprise. You've seen the move in crude this morning. We're down 2.5% on that sector. Top of the pile is information technology. We advanced there 0.2%, and it was big tech that led the recovery 1 year ago. 1 year from the market bottom, and what a year it has been. The coronavirus sending stocks tumbling 34% at the fastest pace on record, and then the snapback. What a snapback it's been. For more, it's Taylor Riggs.
That a year ago today we ended the fastest bear market on record and began what was going to be the best first year of a bull market ever. You mentioned, of course, the S&P 500 up 187% or so in the last year. The Russell 2000, those small cap stocks, that reflationary trade, up 124%. Tech as well, sort of leading up there as well. Just unbelievable the gains that we have seen for tech in the NASDAQ 100. It was the best start to a year going back since the dot-com bubble. So big tech really showing its strength. How much of this, of course, due to low yields? You have yields very low through 2020, and then the curve steepening. If you flip up the board, you see in the last year, it's the 2s, 10s, it's the 5s, 30s that really are up 100 basis points, really 1%. But of course, the short end of that curve going nowhere on the bottom there of the screen. Finally, flip up the board. John, I hate to rag on you, but it really is your Europe that's been lagging the broader rally, at least in the U.S., as we think about the trade of U.S. versus the rest of the world. Their shutdowns have lasted longer, and of course, we do know some frustrations with the vaccine rollout, but all in all, it's green across the screen, John.
I'm neutral. I live in America. Taylor, thank you. Taylor Riggs. In your bond market, yields in 4 basis points. Your 10-year, 165, 30s, 237 in 3 basis points. And this huge debate about the rotation over the last several months, not just the last several months, over the last year, as Taylor went through that snapback, it was led by big tech. And then the cyclicals started to get involved in a bigger way, particularly at the start of this year where the leadership really took over with the small caps, the financials, the energy players as well. On that debate of the moment, Brian Levitt of Invesco, Tallbackens, Michael Purvis. Brian, I want to start here. A good friend of mine, used to be a colleague as well, Luke Carr over at UBS, mentioned recently, just stick with it. having the patience just to stick with this story and just let it play out, because there's more to play out. How difficult is it just to let this play out?
I don't think it's difficult to let it play out. I mean, we know there'll be fits and starts. There's still challenges that we face, but investors need to have a plan and stick to it. And the reality is economies move in 4 different regimes. And in a recovery regime, you see value and cyclicals outperform. As you move into an expansion, honestly, it's value and growth. So all of this debate, by the time we're back in the expansion phase of the cycle, it's value and growth. And then, of course, we'd expect the slowdown to come after this burst of economic activity, and then you're largely back in a growth market. So I say stick to that type of plan. The recovery is going to continue to play out. Value stocks will do well, but I don't think we need to be selling all of our structural growth winners. They'll be back in vogue on days like today, and they'll be back in vogue long term before we know it.
Well, Brian, it's interesting you say that, because a lot of people will come on this program and say it's time to get active, bottom-up analysis, stock picking again, back in vogue. It's going to be here to stay. Basically, what I just heard from you is buy the index, sit there, and walk away.
Well, that's not necessarily true. I mean, if you're thinking about structural growth winners, there are going to be names that are going to be the persistent outperformers. And so, you know, investors that can find them and take advantage of it are going to be the beneficiaries. So I don't know that you necessarily need to think about it from a passive perspective. There are companies that are on the cutting edge of these structural changes that are taking place in society and will likely be the winners.
Michael Purvis, your take?
Look, I think you're looking at a situation where, you know, nominal GDP this year, next year, that combined level, you know, you're talking mid-teens on a combined basis. You haven't seen that really since back until the 80s, right? So I think there's, you know, to your point about, you know, Luke Kawas, stay with it. Yeah, there's a lot to work with here. There's no question that there's a lot to work with here. You know, I think right now, in the here and now, you know, if you're trading, you know, through the day or through the week, it's a little bit of a sophomore slump, if you will, right? There's, you know, we're between earnings seasons. The Fed came last week, and it actually didn't outside of the bond market. There was the rest of the asset classes have been sort of a snooze there. As it relates to, you know, Fed Powell's strong reiteration, right? And then, you know, we know there's a blue wave, and we know that Biden has talked about $3 trillion of incremental stimulus and infrastructure and so forth. But as your colleague Mike McKee points out, you know, that's a 10-year plan, you know, and any infrastructure is hardly, you know, very little of it's shovel ready to begin with, and it's not stuff you can really point to, you know, in the here and now. So we're sort of in this, we all know that valuations are extended. We all know that the rates have been rising here, but it's a very frustrating market in the very here and now. So maybe that's also a sign to just kind of like stay with your core theses and let them ride.
Yeah, I always think it's easy just to take the recent price action, as many people do. The recency bias kicks in, you extrapolate out the trend, and you believe we're at some kind of inflection point. Brian, but I do have to ask, you know, we've had a 5% move lower on the Russell after a massive rip through this year. Let's be clear about that. It's nothing compared to the rally that we've seen. But I do wonder when we start to think about deceleration from 21 to 22, from 22 to 23, and the kind of environment that does better for the secular growth names that have dominated the previous cycle. And Brian, when you talked about reopening, you talked about recovery. Our previous guest from BlackRock talked about restart, a very different dynamic. Recovery can take a long time to play out. Restart's just turning back the lights on. Bang, bang, we restart, and all of a sudden, we get back to where we were really quickly. Brian, can you walk me through those dynamics and how you approach them at the moment?
Yeah, I mean, look, we would all expect a burst in economic activity. Now, there's days like today where we're still dealing with new cases and new variants and concerns about vaccine rollouts in Europe, where you see the market, again, pricing in lower growth, and you see that in the 10-year rate. But I think we all can agree that there will be a burst in economic activity as medicine and science gets further out in front of it. And that's why you see inflation expectations up, you see rates up, you see the deeper value parts of the market outperforming. The question is whether that sustains and whether you need to change your core long-term investment thesis. In my mind, it doesn't. Now, I know there's a huge debate on Wall Street about this, but the reality is that pent-up demand comes in. It's supported by some of the fiscal spending. But ultimately, that fiscal spending should be viewed as income replacement. It does fade as you move into 2022 and 2023. I suspect, you know, a lot of our demands to replace our wardrobes and go out to eat and go travel, we'll do that. But that ultimately starts to dissipate some as well. And you're left back in what I believe is a fairly similar environment to what we saw in the last decade, where you still have long-term structural forces fighting against the U.S. climbing to a new sustained level of growth or new sustained higher interest rate environment, or dare we even say inflationary environment. So if you don't change your core thesis, then you're back to liking structural growth businesses.
Well, something Anna Maletti said a little bit earlier, think less about growth versus value and think more about cyclical growth versus secular growth stories. And Michael added something else onto that. It was a short time horizon and a long time horizon, because I think a lot of people at the moment are associating the cyclical trade with a short time horizon. And then the longer term story, which is something that Brian's just touched on, is a return to trend and get back to the secular growth names. Michael, does that line up, stack up with the way you're approaching this right now, or do you approach it differently?
Well, it does, but I would say that so much of the answer to that question is also unknowable, because we don't know what the trajectory of incremental fiscal stimulus is going to be. And, what happens if the Republicans get the House and the Senate back, in 22? We don't know the answer to that question, and we won't for some time. So that could have a really big impact on this. I think one of the themes that we've really been working with is the fact is this concurrence of monetary with fiscal stimulus is really important to driving above trend growth and stoking the inflation, supporting the higher, longer inflation arguments, because the structural disinflationary forces are so strong, as Brian was just pointing out. So I think it's really important, that whether this fiscal momentum is maintained or not is going to be really determined whether we, revert back to a 2019 or whether we have something different than that. And that determines whether this is just a big bounce in value stocks in the relative performance, or whether it's something, you can sit back and really invest in.
It's a really interesting moment, that's for sure. Mike, it's good to catch up. Michael Purvis there of Toolback, and to you, Brian. Always good to see you, mate. Brian Levitt there of Invesco. In the market right now, the S&P 500 down around about 0.1%. The Nasdaq just about unchanged on the session now. The other performance from the Russell throughout much of this morning. At the market desk with your movers, here's Kriti Gupta.
Well, John, risk off on the surface, but some of those big tech names are, in fact, holding its own. Let's just start off with the ones in the red, though. Let's kick it off with Apple. You are seeing those shares drop a little bit, of course, coming off the best day in 2 weeks. Yesterday's move fueled off by analyst EV hopes. Those EV dreams not helping Tesla, though, today. On the other hand, you have Microsoft and Amazon both in the green, both dealing with some deal news. Microsoft in the green, may bid $10 billion for a Discord. Amazon dealing with a Deliveroo IPO. And then let's take a look at those small tech shares. Of course, GameStop is the big story ahead of this fourth quarter earnings after the bell. It's gaining. And of course, we have eHealth gaining off a 7% stake from Starboard, and Sunrun upgraded over at Goldman, John.
Kriti, thank you. Thank you very much. Coming up, health experts sounding the alarm about a potential resurgence in COVID cases as AstraZeneca faces another PR dilemma. That conversation up next with Debbie Cunningham of Federated Hermes. From New York, this is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse. Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP. But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds on the global economic recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Government has played a significant role in the conduct of this trial. The Data and Safety Monitoring Board was formed by NIAID, which monitored the trial to ensure safety and validity of the data, and it has been given emergency use listing by the WHO.
Dr. Fauci delivering another blow to AstraZeneca's bumpy vaccine rollout, expressing some concerns over outdated data just hours after giving the shot a green light. Let's bring in the Bloomberg team, Taylor Riggs and Guy Johnson. Morning, Taylor.
Yeah, some confusion, John, right, over AstraZeneca. We are awaiting updates in the next 48 hours about the timing of the data that was used, perhaps maybe a month old. So that certainly is what the markets are going to be watching, as well as the reopenings or maybe the pause on the reopenings, as is the case with New Jersey. And then the fighting continues between New York City and New York State about how quickly they can or cannot reopen. Fauci, though, coming out trying to reassure us cases have plateaued, as he tells us not to despair. And indeed, we don't despair, because if you flip up the board, you see that cases are falling. We are now down to a 5-month low and below some of the recent moving averages. Some of this, of course, is the U.S. dependence not on AstraZeneca for those vaccine rollouts. And finally, just flip up the board. Some of the cases are on the rise, of course, in the Northeast, New Jersey, I'd mentioned, but despair not. Hope is on the horizon, John.
Every time you say flip up the board, I'm taking $1. Taylor.
I know, I stole it from you, but you haven't copyrighted it yet.
I would take $3 for this show. I appreciate it. It's patented here at Bloomberg. Don't worry. Taylor Riggs, good to see you. Looking forward to the program a little bit later. The story over in Europe. I don't want to talk about the science. I'm not qualified. I want to talk about the marketing, the PR issues around this. I want to bring in a good friend and colleague, Guy Johnson, out of London. Guy, there's a big issue here, isn't there?
I think you need to separate the Astra from the Oxford now, John. I think that's an important distinction. I think there are clearly errors in the way that Astra is communicating and delivering the data. And what I mean by this is I think you need to separate how the data is being delivered, how this is being marketed, the lack of focus on the fact that this is being done at cost, etc. That all is basically down to Astra, I think. The Oxford, I think, is the vaccine, which, as Fauci says, is probably a good vaccine. It's just not being given a decent shot at this point. You pointed this out with Lisa a bit earlier on. This is not important for the US. This doesn't matter for the US. It matters a lot in Europe. You see the case counts and what's happening in Europe. You see this incredibly strict Easter lockdown that is being delivered in Germany now by the Merkel administration. And it really means something here. This has to happen and it has to work. And Europe has been a constant thorn in the side of this vaccine. It does look as if we are going Dutch, though. Some deal could be formed, John. It looks like between the UK and the EU in terms of sharing the vaccine, the Astra vaccine that's coming out of a plant in the Netherlands. They still need to ramp up production of a plant in Germany, which still hasn't received authorization to produce the vaccine, though is producing it, so it can't produce that and pass it on. It's a mess, John. It's an absolute mess. But if you take a look at what is happening in the UK is basically down in terms of excess deaths, John, to the seasonal normal. That's the impact the vaccine program has had in the UK. 50% of adults have now been vaccinated. John.
Unreal numbers, Guy, thank you. And looking forward to the coverage at the top of the hour. Guy taking you through the European close in around about 12 minutes or so. I want to turn to Debbie Cunningham now of Federated Hermes. She joins us. Debbie, I want to start here. My friend and colleague Guy has just gone through the issues that are playing out in Europe right now. We spent the week talking about Turkey, Russia. We talked about Brazil. Now, obviously, those countries have got their own individual issues at the moment, but in line with all of this, yields are higher in those countries too. And Debbie, it is totally inconsistent with the outlook. When you see what's happening worldwide, do you see some limits to this move in treasuries? Are you informed by what happens outside of America?
Absolutely. Just to pick up on what the last discussion was covering, certainly the lockdowns that we've seen in France now, in Italy, new ones coming in Germany. I think it's the UK is charging £5,000 for anybody that leaves the country and goes to another European country at this point through the end of May. Those have impacts not just on Europe itself, but to its trading partners, and the United States is one of those. So, we are not a singular country. We can take care of what, we feel is necessary from a vaccine and a COVID perspective here in the US, but it has implications broad-based. And, I think, our program that we're running from, state to state are inconsistent, but have nonetheless been pretty effective. You can't say that for the rest of the world.
You can't say it about Europe, that's for sure. So, Debbie, we have this dynamic around the vaccine rollout and the clear limits of pushing yields higher in Europe and elsewhere at the moment because it's just inconsistent with the outlook there, and central banks have stepped back in. Debbie, we also have what many people have talked about for the last 12 months, maybe our diminished tolerance for higher interest rates worldwide because the amount of debt we've added to the economy as well. Now, I just wonder, you put these things together at the moment, you think about the move we've had in treasuries and how self-limiting another leg higher could be in treasury yields. Debbie, how are you approaching that dynamic at the moment?
Well, our thought process is certainly that, where we are right now from a fixed income yield curve standpoint is probably not going, there will be highs that are tested, but it's not going to be, that most of the move is behind us. And then the front end, obviously, is still very much, out to 2 years, in fact, anchored by Fed policy. And, we'll continue to hear from Fed policy makers this afternoon, to include Powell and Yellen with Congress, that the Fed will be lower for longer. So I think the steepness that we see, from overnight to out to 30 years is probably, limiting to some degree on various economies and what's happening from a recovery standpoint. But by the same token, the short end of the curve is going to be very low for the next year to 2 years, and that should be helpful to promote growth. As we start to reopen a little bit more, as we go from 50% capacity to 75% capacity, as we reopen sporting, entertainment, and other type of leisure events, I think you'll see the lower interest rates on the front end of the yield curve be very helpful there, but the limiting factor being the higher yields that we see a little bit further out the curve, 5, 10, 20 years.
Debbie, I want to finish on supply if we can. Last time you and I caught up, we touched on this issue, I think, just briefly. We have allowed the SLR exemption to expire. The Federal Reserve is letting that happen. That will take place at the end of this month. Big debate about where that would show up. Maybe a stress point could be the supply we get later this week. 2 years today, I think we get 5-year notes tomorrow. Thursday, $62 billion of 7-year notes. Any concerns around that story, Debbie, around supply, our ability to take down a lot of this issuance?
I think at this point, in addition to supply, it's a story about demand, and there still is a lot of demand on the front end. We've seen reserves, the Fed's reserves in the system nearly cut in half over the course of the last 2 months, from 1.7 trillion down to where we are at about $1 trillion right now. So that's additional demand in the system for those treasuries that are being newly issued on a supply basis, but are also being released from the banking system. And to some degree, when you look at the capacity in the banking system and what they have on hand, it's about 2 trillion, I think, in Treasury securities that have been impactful in that SLR equation that will now either continue to be held and not as favorably with the banks or be released out into the system. It helps from a supply standpoint. It helps mitigate and even out some of that demand and supply.
Yeah.
I think there is, the mix that will allow that paper to be absorbed into the system pretty normally, with maybe a little bit of a positive impact on short-term, but not huge.
Debbie, love catching up with you. Come back soon, won't you? Debbie Cunningham there on this story in the bond market. From New York, your trading diary next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
"26 minutes in, equities lower by 1.25% on the Russell. That's where your underperformance is. The S&P 500 down a tenth. Here's the trading diary. A massive few days of Fed speak. Chairman Powell headlining it all, spending the next 2 days on Capitol Hill, testifying before Congress with Secretary Yellen. Vice Chair Clarida on Thursday, plus 180 billion in supply. Throughout the week from the Treasury, 62 billion of 7-year notes coming up on Thursday. And on Friday, we round out the week with the Fed's favored inflation gauge. From New York, that does it for me. This was the Countdown to the Open. Catch me on Twitter to continue the conversation at Fero TV. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality. We need better public policy and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay. In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for fifth generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.